Banks are raising interest rates again. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from Yahoo Finance discussing banks raising interest rates again. Now yesterday I received an email. It was breaking news from a mortgage broker I had met several years ago for a coffee, networking. Back when I was just doing the networking thing all the time. And, I probably should start it up again, to be honest. And, well, this breaking news that he had to share with me in his email was that the RBA had capped the cash rate at 0.1%. Wow, shock, horror, gasp, guys. It's kept it at 0.1%. Is anyone surprised? I can't imagine how that's breaking. It would have been breaking or shocking if they had actually raised the rate. I wonder, what's going to happen when they actually raise it? We'll be here for it. Hopefully we'll live long enough to see it. What will that do to consumer confidence? What will that do to mortgages? Even just a tiny rate rise, it's going to freak everyone out because we're only used to it going down pretty much. There we go. They're the good old days. Imagine how much interest you would have gotten on your money, just sitting your money cash in the bank and just earning your money. Wow. Anyway, let's have a look at this article because private banks are raising rates, guys. The RBA isn't, but that doesn't stop the banks from hiking their interest rates. They're starting to go up. They're creeping up bit by bit. So the latest bank offering a 4-year fixed rate below 2% has increased its rate, suggesting the ultra-low rate, the last bank, the ultra-low rate environment is beginning to expire. Now, we locked in our mortgage at below 2%. We did it so I would stop paying off the mortgage and set the money aside that we had for our renovations. Because I will do an update video for everyone soon who's interested. We're demolishing the house and doing renovations, all these crazy things. So Bank Vic has announced its 4-year fixed home loan rate will increase from 1.95% to 2.25%, meaning no lenders now offer similar products with rates below 2%. So this doesn't mean if you've got this mortgage, guys, your rate's going to go up if you've already locked it in. If you locked it in, it's locked in. What it means is that no one else is able to get this deal. At the beginning of 2020, 32 lenders offered 4-year products with rates below 2%. A number of record low rates have been relegated to the history books over the last 2 months as lenders took some of the lowest rates off the table, ratecity.com.au research director Sally Tyndall said. They're coming to an end, guys. Sub 2% rates. I mean, I see it on my mortgage. The interest money is so cheap. That's the problem. Cheaper money means more money is going to be borrowed. What's the easiest way to borrow money in Australia? For property. Everyone loves it. And what happens when you borrow money? You get the Cantillon effect, guys. The Cantillon effect refers to the change in relative prices resulting from a change in money supply. So as we're borrowing this money and pumping it into property, the money supply is increasing. And the change in relative prices occurs because the change in money supply has a specific injection point, a specific flow path through the economy. And where is that in Australia, guys? Housing, property. You add the fact that, that's culturally, I would say culturally, property is Australian gold. What do you think? Do you think that's, is that a bold claim? I don't think it is. And add to that our government intervention in the property market. Well, there you go. There are now just 2 rates that are still at record lows. The reduced home loans variable rate at 1.7% and BCU's 1-year fixed rate at 1.67%. All other lowest rates have been hiked. We expect more fixed rates will rise after the Reserve Bank of Australia's term funding facility wraps up at the end of this month, and we edge closer to the next cash rate hike. So banks move on interest rates. While most lenders are keeping rates low, long-term products are beginning to see their interest rates click higher. Some 25 lenders have increased their 5-year fixed rates, while 4 have cut in the last 2 months. For short-term loans, lenders are still generally pushing rates lower. Most, 27 lenders, have cut their 2-year fixed rates, while only 8 have hiked, and 15 lenders have cut their 3-year fixed rates, while 11 have hiked those products. Across variable rates, 31 lenders have cut at least one variable rate. However, there are still dozens of products with short terms offering interest rates below 2%. There are 36 1-year fixed rates below 2% and another 78 2-year fixed rates and 52 3-year fixed rates. In total, there are 189 home loan products on the Rate City database with sub 2% interest rates. Mortgage holders are still spoiled for choice, Tyndall said. So who has the lowest rates, everyone? BCU has the lowest 1- and 2-year fixed rates at 1.67% and 1.78% respectively. For 3-year fixed rates, Credit Union SA has the lowest at 1.79, while Home Bank's 2.04 is the lowest 4-year fixed rates. So you can't get a 4-year below 2% anymore. ANZU Bank offers the lowest 5-year fixed rate at 2.25%, and reduced home loans 1.77% is the lowest variable rate on offer. Across the major banks, Westpac's 1.79% 2-year fixed rate is the lowest on offer. So there you go, everyone. There you go. You can still find some 2% rates out there if you want to fix for shorter periods, but you can't fix a sub 2% 4-year anymore. They've disappeared. All the while, the Reserve Bank hasn't actually increased the cash rate at all. So what's going to happen? What's going to happen when we see this increase? Because it's going to increase. The Reserve Bank is going to increase the rates. What are the banks going to do? And what's the solution to all of this for people who are in financial stress? We're seeing article after article talking about mortgage stress. Now, I question the validity of those claims because I think it doesn't take into account the earning income of people. If you're earning a significant amount of money, well above median, you should be fine, guys. You know? So what's the solution? I'd say we need to, raising rates are only an issue if you're overborrowed, if you're over-leveraged, if you've borrowed too much. We need to increase our financial literacy. I want to encourage freedom of debt because I would argue that facilitates greater individuality. And we need to promote a wider understanding of Austrian economics just in general. As always, guys, thanks for watching. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions on this one. Are you worried about a rate hike, or are you looking forward to it? As always, if you're a fan and want to support us, there are a few ways you can. You can join us on YouTube or Patreon. Support us using SelfWealth or Stake. Sign up for our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy a merch from HeiseSays. Use Gold Pass from the Perth Mint or support us via PayPal. Take care, and I'll see you next time. Bye for now.